welcome to another live technical analysis. We're going to be starting off, as usual, with the euro against the US dollar. So, we should mention some financial releases in addition to monetary policy in terms of the FOMC's December meeting minutes. Now, in terms of financial releases, we note that the ISM manufacturing PMI figure came in better than expected, implying a narrowing in contraction in the US manufacturing activity that appears to be contradicting the S&P manufacturing PMI, which came in lower than expected. Yet, it appears that both of these indicators conclude and coincide with each other and agree on one thing, that the US manufacturing economy is contracting, which may be worrying for the United States and in particular the US dollar over a more longer time period. Now, furthermore, the jolly shop openings figure came in lower than expected, implying a loosening labor market. Now, that could also aid the market expectations of six rate cuts by the Fed during this year. Therefore, that may have weakened the US dollar, but in contrast, it appears to have supported the US dollar during yesterday's trading day. For today, it appears that it is slightly moving higher, having bounced off support, which we're simply readjusting to these two blocks 1.0906, simply round it up. So we would now switch from a bearish outlook to a sideways bias, having broken above our downwards moving trend line. RSI is actually near 50, so it's at 45, aiming for 50, implying a relatively neutral market sentiment. It appears that it has touched the mid-range of the Bollinger Bands, and although they're being tilted towards the downside, implying a bearish market sentiment, we would, at least for now, maintain a sideways bias for the rest of the day. So staying between S1 and R1 for our sideways bias to continue to be validated. Whereas should it break below S1, we would switch towards a bearish outlook. And if it does break above R1, we would switch towards a bullish outlook. Now, in terms of the FOMC's December meeting minutes, what was interesting was that the Fed implied that they are likely at the terminal rate. So the discussion for future rate hikes it would appear is relatively out of the picture for now. So what's the current implications of the FOMC's meeting minutes? Well, they appear to be dovish, as was expected. Yet, they may have disappointed perhaps market participants who were looking for more clear cut guidelines as to when the Fed would cut. Moreover, in the FOMC's December meeting minutes, it was implied that the current interest rates may need to stay at their current levels for a prolonged period of time, perhaps even more than what was previously anticipated. As such, we may see strength for the US dollar against other pairs such as the British pound, the Japanese yen, the Aussie, the dollar, the Kiwi, etc. So we may see the dollar gaining if the Fed follows through on their intentions. So if they keep the current interest levels on pat, for example, they stay on hold for 2 or 3 interest rate decisions. So when they're meeting, they stay on hold. We may see the dollar gaining from a more macro perspective. Now, if they do not, we may see the market expectations of 6 rate cuts potentially being materialized, which could weaken the US dollar and as such providing support for other currencies, for example, the euro, the British pound, etc., etc. Now, we noted that the PMI figures for the UK came in lower than expected, which may have weakened the British pound. But for today, it appears that the US dollar is weakening in terms of the euro and the British pound. Now, for the euro in particular, it appears that inflationary pressures in the eurozone are persistent on a year-on-year level. The reason as to why the euro may have slightly lost earlier on today was on the month-on-month level. The inflation pressures appear to be easing. So perhaps some alleviation of concern for the euro area. But for now, it appears that the predominant figure, so the year-on-year level, which appears to be more important, may be taking control over the pair and guiding the pair towards a sideways bias between S1 and R1, as we had previously mentioned. So for now, Euro USD between S1 and R1, breaking above R1, bullish outlook, staying between S1 and R1, sideways, whereas breaking below S1, we switch towards a bearish outlook. Now, for the British pound, we can see that it's actually broken above R1 that we had placed yesterday, 1.2720. Well, if not broken above, actually having broken above. Note how it opened on R1. So we would switch R1 from R1 to potentially S1. Now, the problem with switching R1 to a S1, whilst the price action is on the current support level or resistance, depending on how you look at it, is that it could easily break below. It could turn around. This could actually be a bearish candle, come back down, and then it would be invalidated. So, for a bearish outlook, it would not only have to break below S1, it would have to break below another level of support. Now, the same would go for resistance if it was support and resistance and it was at the same level. So, for now, we could maintain a slightly bullish outlook for the British pound as it's broken above R1. The RSI is above R1, but still below 60. But the difference between the euro and cable is that the RSI is at 50, so 46, so near 50. It's reached the mid range of the Bollinger Bands, appears to be validating this mid range, staying between S1 and R1. Whereas for the British pound, it's broken above our old resistance level. So for the British pound, we could be slightly more bullish, although wary for a potential reversal. It could also be facilitated by an upwards moving trend line. But for now, I maintain a short term bullish outlook for cable. Now I need to readjust my support and resistance levels. So this would be S1, 1.2720. And then we're also readjusting S2, bringing it slightly higher to reflect the new price action. So 1.2615, that could be S2. And let's just switch actually RS3 text label, make this easier and faster. 1.2615 for S2. For S3, 1.2475. And we're removing our old support line. Now for R1, previous high, upper range of the Bollinger Bands, potential for resistance 1.2810, 1.2810, and then we'd need to find R2 since R1 and R3 are fairly quite far apart from each other. We need to find something in the middle, so perhaps this previous high validated by this wick. And let's just zoom in, make sure that that is actually valid. Slightly lower. Recent price action validated, and as such, that could be R2. But R1 with R2 is still fairly close to each other. Like if you compare S1 and S2 and then you see R1 and R2, then like it could easily be broken within a single session. So perhaps it might be more prudent for us to search for an alternative towards R2. Now, that might actually be resistance. I'm not saying it's not. It's just could easily be broken in terms of targets, etc. And take this previous swing low and then 1.20915. 0.15, and then let's zoom in. Actually, let's get a clearer picture. R3, 1.2901, round it up, or we could even say 1.20195. But if we round it up, it'd be 1.29000. And then R1, 1.2810. S1 1.2720, which was resistance, now turned to support. S2 1.6 1.2615, then S3 1.2475. Have S1, S2, S3 touching while resting upon S1. So for a bearish outlook, breaks above below S2. For a bullish outlook, we have to simply break above R1. Let's add another indicator as well. Insert indicators. Personally, I like using volume as well. Increase perhaps a weak bullish candle, but it hasn't closed. So we should actually see more. Perhaps another indicator as well. Ichimoku might be nice. Parabolic SAR. Moving averages, envelopes. Well, what could we use? We could use RSI. Now we have RSI. We could keep it simple for now. Let's see if the commodity channel index needs to be a relatively sideways fashion. Might be due a correction slightly lower. So I'd have one of two options. I wouldn't be bearish. I look at it from a different point of view. I'd be bullish if it breaks above R1, but if it fails to break above R1, I would switch towards a sideways bias between S1 and R1. Well, let's make this a bit more clean. S1, S2, S3. For the dollar against the Japanese yen, bullish outlook, upwards moving trend line, RSI near 70, implying a strong bullish market sentiment. Above R1, so resistance turned to support. Once again, it's resting on S1. Therefore, for a bearish outlook, we will have to break below S2 as well. Then let's switch this from R1 to S1. Turn this to green. Then for S2, 142.50. S3, 140.85. And then we'd have R1, 145.20. R2, 146.50. And then hunting for R3. On 47.70. So move all this 3. So 147.70. We're going to be looking at oil and gold as well. So we would maintain a bullish outlook for the pair as long as it stays above S1 and moves towards R1, if not breaking R1 as well. For a sideways bias, staying between S1 and R1. Now, Bollinger Band still towards the upside. Bearish outlook needs to break S2 as well. For the Aussie, or we could actually look at the dollar CAD or Loonie. Now, the CAD may be gaining either due to slightly, I wouldn't say weakening dollar. So for the day, dollar still appears to be holding its own against the US dollar, against the Australian dollar. It's gaining against the Japanese yen. It's losing against the pound and the euro, but it's not a sign of overall general weakness as it is gaining against the yen. For the CAD, though, the Canadian dollar might be gaining against the US dollar due to WTI, essentially crude oil. Crude oil appears to be on the rise, and Reuters has attributed the potential for oil's rise due to protests at one of Libya's largest oil refineries, which produce around 300,000 barrels per day. So, concerns about supply, increasing oil prices, and the continuation of attacks by the Houthi rebels appear to be boosting oil prices. So, as we said yesterday, from a technical, it looked like it was going in a downwards fashion. From a fundamental point of view, would have been going higher. And as such, it appears that the fundamentals have overtaken the technicals. So this could be resistance turn to support. Then you have S2 and S3. Now aiming for R1, 43.74.35, which was our R2 yesterday. So switching this to R1. Then we have R2. And then we could place resistance at R3 at this previous high. Yes, it is slightly close to R2, but in this case, given the distance between the resistance levels, it's not that bad. It's okay for now. Or if you'd like to play it slightly more on the safer side, we could take this previous low, which is potentially a resistance level as well. And if it becomes big figure 80, key resistance level, so that would be our R3. Since we're looking at this from a more longer term perspective, we're on the 4-hour time frame as well, or on the 15-minute or 30-minute. So we have R1, 77.55 for R2. Oil, in my own personal opinion, might move higher. The API weekly crude oil inventories implied a greater drawdown than what was expected by economists, implying that demand for oil may be increasing. As such, oil traders may be interested in the EIA weekly crude oil report, which is due out today, in order to potentially validate the figure that was released yesterday, implying a greater than expected demand for oil. Thus, you have fundamentals and financial releases potentially aiding in crude oil's ascent. Therefore, from a technical and fundamental point of view, would maintain a bullish outlook if it breaks above R1. I wouldn't form an upwards moving trend line as it's far too steep. It has broken our downwards moving trend line. It's above the mid range of the Bollinger Bands. RSI slightly above 50. So two scenarios, predominantly one from a fundamental and financial releases would be bullish. So if it breaks above R1, but the second would not be bearish. It would be rather a sideways fashion between S1 and R1. 66.90, that would be S3. So you have S1, S2, S3. R1, R2, and R3. No upwards moving trend line for now. Has broken above, aiming for a 1, and predominantly bullish given that it broke above resistance turn support at 71.40. So bullish on oil. Looking at gold as well. Now, as we said before, just see old support and resistance levels. Let's remove those. 2136, R3, all-time high. R2, 2090, R1, 2048. Currently testing resistance, hasn't really broken above. It actually just barely has. So we could simply slightly higher. 2050. Now, actually, 2050 brings it right there. Now, the reason for gold, as to why I'm not switching this to support, is that it's slightly more clearer on the forex pairs rather than gold. As you can see, gold has been more of a gradual rise, whereas for the euro, we don't actually change. For the pound, strong upwards motion. Japanese yen, strong upwards motion as well, whereas gold has been slightly more gradual. So this could be small market correction before moving lower. But technicals below 50, but above 40. So slight, I'd say neutral market sentiment for gold. 2090. And then for S1, If you'd like, you could place 2025 for S1, S2 1988, and then for S3 1957. So you have S1, S2, S3, not forming an upwards moving trend line as of yet, but we could form a downwards moving trend line from a more macro perspective. So for a bullish outlook, breaking above R1. Now for a continued bullish outlook, it needs to break above R2. If it doesn't, sideways bias between R1 and R2, which this would be resistance and support, and this would be R1. For a bearish outlook, simply breaking below S1 would be sufficient. The RSI bounced off 30, come back up. This could be correction before moving lower, but that remains to be seen. We're also going to be looking at a few others today. Now, the S&P 500, a downward trajectory, RSI below 30, actually running along the figure of 30. It's 27, so you could say that, which implies a bearish market sentiment. So I'd maintain a bearish outlook for the S&P 500 if it manages to break below 4,700, and then next target 4,600, and then lastly S3 4,490. Now zoom in, validating the downwards moving trend line. Bollinger Bands appear to be tilting towards the downside, decreasing volume as well. Bearish outlook for the S&P 500. I could simply fix, I'm going to be fixing the text labels. Just make this look nicer. So 4,600 for S2, and then you have 4,490 for S3. For S1, 4,795. $4,960 for R2. Then 5,110 for R3. And this would be R3. So maintaining a bearish outlook for the S&P 500 from a technical point of view. There we go. Much better. For a bullish outlook, simply breaking above R1. Dow Jones 30. If we move on to the 4-hour. On the daily as well. It was perhaps overbought and is now correcting lower. For our time frame, confusion with the text labels. Maintaining a bearish outlook for the Dow Jones 30 as well. So I'd take this to be resistance turns to support. And for the text labels, let's just place them to the side for now. And let's look more at the chart. So you could have said that this was an upwards moving trend line. Then you could have said this was a second one. It's broken it twice. So I wouldn't be bullish for the Dow Jones 30. I'd maintain either a sideways bias between S1 and R1 or a bearish outlook, depending on how you see it. If you move on to the daily, you can see at this point, perhaps RSI above 70, implying it was overbought, correcting lower. If it fails to break above R1, then I would switch towards a sideways bias. If it breaks below S1, I would immediately switch to a bearish outlook for the index. But for now, sideways between S1 and R1. If it breaks below support, switch to bearish. If it breaks above resistance, then I would switch towards a bullish outlook. Now, on the other hand, the Nasdaq index, bearish. Why? Bollinger Bands being tilted. Notice the difference. Let's just switch it to the daily for all three major indexes, daily and daily as well. So one could say the S&P 500 is slightly more moderate, perhaps a decline if it breaks below S1. RSI moving towards 50, so perhaps a sideways bias, neutral. Now the Dow Jones 30 appears to be holding on better than its counterparts, so the S&P 500 and the Nasdaq. But if you look at the Nasdaq on the daily chart as well, compared to the S&P and the Dow Jones 30, the RSI much lower, so sideways. But based on the recent price action, I would be bearish for the Nasdaq. So bearish if it breaks below S1 though. For my bearish outlook to be confirmed, it would have to break below S1. If it does not, sideways between S1 and R1. But as you can see, it appears that Nasdaq is leading the bears, at least for now. So bearish, perhaps slightly neutral between S1 and R1, and bearish for the Nasdaq. So US 100 cash is the Nasdaq. Oil, as we said, we're bullish. Gold, if it breaks above R1, I'd maintain a sideways bias between resistance, which would be turned to support, and R2. For a bullish outlook, it will have to break above R2. If it does not, sideways, if it breaks below S1, I would switch towards a bearish outlook. Now we're going to be looking at perhaps Google as well. Let's remove our support and resistance levels and let's just draw them again. Although it's actually spot on between R2 and R3. So we're simply removing our support levels. So I'd switch this for S1, $136. Then for S2, 132.45. And then for S3, I'd take this slow, 128.30. So this would be my S1, S2, and S3. Note, it failed to break below S1. It failed to break above R1. RSI, 56, so neutral market sentiment, or so it is implied. Let's go back and see where we can place. We cannot. Yes, the stock split. So we need to draw our imaginary resistance levels. R2, 142.10. And then considering we have about $4 in between our support levels, so this could be 146 for R3. So 146. RSI is at 50. Now look at the price action. Now this is on the daily chart. If you look at the 4-hour, things might be slightly more clearer. So this could be a sideways, but we should add another indicator as well to validate our hypothesis. So what you could do, you could potentially add the Bollinger Bands. Bollinger Bands appear to be narrowing as well. On the daily, well, given that it's a stock, on the daily it appears to be wide. Yes, that's fair. But on the 4-hour, slightly narrowing. So you could maintain a sideways bias between S1 and R1. Although that might be slightly difficult. If it fails to break above R1 once the market does open, I would switch to sideways bias. If it does break above R1, I'd switch towards a bullish outlook aiming for R2. If it manages to break below S1, I'd switch towards a bearish outlook. Note how this gap was filled. So it filled this gap, came back down, validated R1. It also did test around 3 sessions ago S1 136. So based on what we've said, we'll see perhaps together next week for Google. What we could do, have we done Apple? Apple tested and is currently tested support 183.80, and we're going to be marking this gap for future reference. So we're taking a shape. We're on our MT4 platform, taking it between the two wicks. So this might be filled in the future. And now we could say, if we just slightly readjust, 183.10 could be your S1. Let's make this slightly larger. 178.40 S2. I'd remove 178.40. I'd rather go with 172 and then 161.30. Give it some room to breathe. As you can see, it moves around. There's a gap. So for now, bearish outlook. RSI 32, implying a strong bearish market sentiment. Now, I would not be surprised if it fills the gap, tests resistance before moving lower. But if it fails to break below S1 and R1, I would maintain a sideways bias for Apple's stock price. If it breaks above R1, next target for me would be the 200.20 level, actually slightly lower, 199.60. I'm looking at this candle right here. 199.60 would be my R2. Higher than that, 208.45. I want to look at Nvidia as well, which I'm not sure if we looked at yesterday. Morgan Stanley, Goldman Sachs. Actually, JP Morgan created new all-time highs yesterday. Sociedad General, Banco Santander, Amazon bearish outlook broken below. So this could have been resistance and support, now turned back to resistance. We already have our support and resistance levels on the daily chart. So you could take a screenshot, perhaps add these to your own chart and see how the price action moves. RSI dropping below 50. They've narrowed, but since it's broken below, I switch towards a bearish outlook. If it fails to break below S1, I would maintain a sideways bias. So, and then you have Ford, UBS, Tesla. Tesla is an interesting story. Commerzbank, Google, Walmart, Airpass, BA, ExxonMobil. I'm going to actually look at ExxonMobil today. We'll do two more. We'll do ExxonMobil and we'll do Tesla. So let's clear our charts. As a small reminder, we have the 2 RSI. For Tesla, candlesticks, open, high, low, close. This is my color scheme, green and red. Period separators shows the different trading sessions, but when you're looking at charts all day, I'd rather not have the period separators. I'd rather have it's clear. So if you can't really see the RSI, which is slightly in blue, it's at 36, implying that there is a bearish market sentiment as it is below 50 and below 40. So strong bearish market sentiment. We're going to be adding volume as well to our chart. So indicators, volumes, there we go, green and red. Declining volume. So I'd maintain a bearish outlook for Tesla's stock price. Now, let's zoom slightly in on the chart. Turn this to green. Let's make this line slightly more visible. So we're taking this previous swing low. I wouldn't place it higher. It's already moving lower. Therefore, I'd place S1 230.30. That would be S1. Then for S2, 208.90, and then S3, this previous low as well. Actually, I'm going to use the wick for this one. 193.85. Fair enough. We have S1, S2, and S3. For resistance, this might be slightly unorthodox. I'm taking the swing high, and I'm using the close, and the open of these candles respectively. Note this bearish block that closed, not even a wick, failed to break below and then moved higher, validated by this wick. So 246.85 as my R1. So I have R1. R2, I take this previous high, 262.95 if you round it up, actually 90. And then for our 3, previous high as well, 277.55. So you have our 1, our 2, our 3. From a technical point of view, RSI 36, bearish market sentiment, aiming for S1. For our bearish outlook to continue, breaking below 230.30, aiming for 208.90. Bullish outlook, breaking above 246.85 would be sufficient enough, in my opinion, for a bullish outlook to emerge. Now, ExxonMobil, we actually haven't changed our support and resistance levels, which is quite nice, if I'm being honest. Sideways bias between S1 and R1, so at 97.40 and on 105.20. Now, ExxonMobil is an interesting story in terms of Venezuela and Guyana. The dispute over the Essequibo region could come into play for ExxonMobil, given that they're a predominant shareholder of the Essequibo offshore region that recently discovered oil reserves. So could impact ExxonMobil's price. For now, narrowing of the Bollinger Bands, RSI at 54 implies a neutral market sentiment overall for the company's stock price. I'd maintain a sideways bias as long as it remains between 105.20 and 97.40. If it breaks above R1, I would switch towards a bullish outlook. And if you'd like to add another technical indicator, it broke above a downwards moving trend line, so sideways bias between S1 and R1. Breaking below S1 would constitute as a bearish outlook. Next target being 89.96 or 95 if you're rounding down. So sideways bias for ExxonMobil stock price. And with that, I think that does it for today. Thank you for watching, and I'll see you next week.
Everyone, my name is Emily and welcome to another educational video. As part of our technical analysis series, we would like to look at the technical indicator called moving average. A moving average displays the average of data points across a predetermined number of time periods, typically price data. Because each data point is computed using information from X number of prior time periods, it is referred to as a moving average. Moving averages smooth the price data to create a trend tracking indicator by averaging previous data. Although they lag since they are dependent on historical values, they determine the current direction of the price rather than predicting it. Moving averages help smooth out fluctuations in market prices, filtering out the noise and making it easier to establish underlying trends. They also serve to alert traders to important changes in direction. Moving averages can be used to indicate potential support and resistance level, as well as the trend's direction. Additionally, they serve as the foundation for additional technical overlays and indicators, including Bollinger Bands, MACD, and the McClellan oscillator. The most popular is the simple moving average. By calculating the average price of a security over a predetermined number of periods, a simple moving average is created. For a 5-day moving average, you simply add the closing prices of the last 5 closings and divide this sum by 5. You add each new closing and skip the oldest. A moving average is an average that moves as its name suggests. The average moves along the time scale as new data is added and old data is deleted. The method is the same whether you choose a 10-day average or a 40-week average. Rather than adding 5 days, you add 10 days or 40 weeks and divide the amount by 10 or 40 as appropriate. Thank you so much for watching us today, guys. See you soon.
Okay, let's go ahead and get right into it. So, as per usual, a risk warning and disclaimer before I get started. So, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie. I will be your speaker for today. I am an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research from 2019 to 2021. So here's our agenda for today. We're just going to look at some fundamentals first, and then we'll look at some trading strategies for gold, some indicators that you can use, and I've also included some stop loss techniques, so some exit as well as entry rules as well. Okay, let's get started. Feel free to let me know throughout the webinar if you guys have any questions. Just let me know in the chat. Okay. So, firstly, we're going to start off with the fundamentals, okay? So we're going to firstly look at the demand and production of gold worldwide. So starting off with the demand, okay, there are a couple of sectors that are high in demand for gold. If you can see in this chart that I got from Statistica, you can see that jewelry amounts for 55.43%. So, and it also represents the largest source of annual demand for gold per sector. However, this has declined over recent decades, but it still accounts for around 50% of total gold demand. And if we're talking about worldwide distribution, we're mainly talking about India as well as China, which are by far the largest jewelry markets, together accounting for over 50% of the global total. Okay, the Asian as well as Middle Eastern markets are dominated by demand for purer and higher carat gold. Next, we have investment. So because it has unique properties as an asset class, which we'll get into in the later slides. So our analysis shows that modest allocations to gold can actually be proven to protect and enhance the performance of an investment portfolio, which is a sentiment that a lot of investors also follow, because they think that it will reduce volatility as well as minimize losses during periods of market shock. Okay, so investors of all sorts are in recent years coming to accept gold as a reliable, more tangible long-term source of value that has moved independently of other assets. Next, central banks accounts for 11.33%. And gold plays an important part in global central bank reserves, and they are they tend to be more significant holders of gold. Okay, so since the 2008 financial crisis, it actually prompted a fundamental shift in central bank behavior towards gold, and it encouraged a reappraisal of its role and relevance in reserve asset management. Okay, so just like how we're talking about individual investors, central banks also have adopted this sentiment. So emerging market central banks have increased their official gold purchasing, while European banks have ceased selling, and the sector now represents a significant source of annual demand for gold. And lastly, we have tech. So tech amounts for 8.21% of gold demand, and how it's used in the industry is mainly okay, there's a broad range of applications, but demand is mainly driven by the electronic sector. So it accounts for about 80% of the gold that's used in technology. The metal is ubiquitous, and most consumer electronics as well as automotive applications, because of its chemical and physical properties, which when combined, it makes it irreplaceable in many high-end devices. Okay, let's move on. So the 2021 gold consumption, this is across a couple of major economies in the world, but you can see that the largest consumer of gold in the world in 2021 is China as well as India, which is what we talked about in the previous slide. As well as China and Russia, which have been the two world leaders in the move to holding larger gold reserves. So this is a pretty outdated graphic, this from 2021. Okay, so just keep that in mind. Okay, so this is the 2022 gold demand. And 2022 was actually the strongest year for gold demand in over a decade. So yeah, it says here in this chart, 2022 gold demand almost matched the 2011 record. So colossal central bank purchases aided by vigorous retail investor buying, as well as slower ETF outflows, lifted annual demand to an 11-year high in 2022. Okay, it actually saw a total annual gold supply increase by 2% last year. Okay, and this is the 2022 CIC gold production. So China produced 330 tons, Australia 320, Russia 320, Canada 220, and US 180. Okay. Okay. So next, let's talk a bit about how gold is used to hedge against inflation as well as crisis. And with people speculating on an upcoming recession, we could be seeing gold being bought a little bit more in the recent months, as well as in the coming months. Okay, so in this graphic here, we're talking about how gold's value increases traditionally during recessions. So gold has been traditionally considered a safe haven asset for investors when markets are in turmoil. So how does gold hold up when the economy tumbles? Okay, so this graphic uses data from macro trends to highlight gold's price movements during recessions and compares it to the changes in the S&P 500. Okay, so it compares the value of gold to the S&P 500 in historical recessions. So if we're mainly talking about, I think over here, the first recession you see here is the 1973 recession. Gold increased by 87%, while the S&P 500 dropped by 13.1%. Okay, the recession length was about 16 months in 1973. If we look at a more recent recession, okay, I think the most recent one would probably be the 2020 recession because of the pandemic and the lockdowns. So that lasted approximately about 2 months, and the percentage change in nominal price of gold was 5.6% increase, and whereas the S&P 500 dropped by 1.4%. Okay, and here it says gold's price reached an all-time high during the pandemic, briefly hitting the $2,000 per ounce mark. Okay, so since 2022, because the global economy has kind of been shaking with the onset of a couple of wars, as well as countries coming out of the pandemic, um, as well as facing high inflation, so on and so forth. I'm sure you guys know. So investors are speculating that it might be gold's time to shine in recent years from 2022, even until now, 2023. Okay, but in fact, history shows that gold often outperforms US stocks and the dollar following interest rate hikes after underperforming in the lead up to rate hikes. Additionally, high inflation is eroding the purchasing power of each dollar, incentivizing investment in a tangible asset like gold, as well as other hard assets. Okay, so with geopolitical uncertainty around the world at a high and the US consumer sentiment at decade lows, what do you guys think about how gold will continue to be a safe haven asset as we move on to 2024? Feel free to let me know in the chat. Okay, I'm just gonna continue. Okay, so this is just a gold versus US recessions chart. This is a weekly chart, that just measures gold futures as well as the period of recessions, on a weekly time frame. And then if we look at gold versus inflation, you can see that it's kind of negatively correlated. As the CPI rises, we can see that the value of gold rises as well. Okay, let's move on. So now we're talking about the US dollar relationship. So relationship with gold. So we see here the robust labor market basically indicates that the Fed will probably keep rates higher. There's a high chance that rates will probably not be cut so soon. And if we look at DXY as well as bond yields, they've spiked on stronger than expected employment figures. Okay, however, these moves were short-lived. So gold versus DXY historically have been negatively correlated. Okay, so if you take a look at this chart, for example, if you look from May to September, whenever we see a rise for the DXY, we can expect the gold to drop. And if DXY drops, we can expect the opposite for gold as well. Okay. Next, let's look at the gold versus US 10-year bond yield. So recent ISM data suggests that inflation is increasing in both manufacturing as well as the services industry. But depending on CPI data, we could see some increases, these increases being fed into the CPI data. So once again, you see that the 10-year bond yields are negatively correlated to our gold as well. Okay. Of course, this doesn't always happen, so you have to do your own comparisons, and maybe I'll show you guys how you can check out or how you can compare the charts on TradingView. Okay, let me just pull up my charts. Okay, so we're talking about gold. Okay, and if I want to add another chart so that I can compare it right on the same chart, I just press this addition sign and then click on this same percentage scale. Okay, you can of course click on the new price scale, but then you would be comparing on a different scale. So I just like to click on this one. Okay, and you can see yeah, as I've explained before, the DXY or the US dollar tends to be negatively correlated the to gold. Okay, so when you're analyzing, you can use this feature. Wait, let me see. Can you guys see my screen? Yeah, okay. Yeah, you can use this feature to basically analyze two charts at once. Okay. Okay, let me know in the chat if you guys have any questions. Okay, if it's all good, let's continue. So now we're going to be talking about the real yield relationship with gold. Okay, so government bond yields are quoted in nominal terms, i.e., the US 10-year bond yield, and real yields are adjusted for inflation expectations. So real yield equals to nominal bond yield minus the expected inflation rate. Okay, now if we look at this chart, this is gold versus real yields. Okay, inverted real 10-year treasury yields. So the interpretation of this, maybe I'll just pop the website into the chat for you guys to take a look at. But the interpretation for this is that the real interest rate is defined as the difference between the nominal interest rate and the expected inflation rate. Okay, so the correlation between real interest rates and the price of gold in this chart is minus 0.82. So basically, when real yields go down, gold goes up. So this links closely to what we've been talking about throughout the webinar, which is that, DXY S&P 500 tends to be negatively correlated to gold. Okay, but we can see now that real yields are also negatively correlated. Okay, so this correlation explains why inflation is gold's best friend, while rate hikes are probably its worst enemy. Okay, so the reason for this is because rising interest rates also mean rising opportunity costs of holding gold. So gold neither pays dividends nor interest. So it's relatively expensive to hold it in the portfolio when interest rates are high. On the other hand, when real yields are negative, holders of cash and bonds are losing wealth. So investors are more prone to buy gold in that scenario. Okay? Okay, now that we have gone through the fundamentals of gold and understanding kind of the science behind gold, let's take a look at some technical analysis tools that you can use when you are trading gold. So trading gold is pretty similar to trading any other currency. Of course, the only addition is that you should be taking note of your fundamentals as well. The fundamentals that we've mentioned previously. Yeah, specifically for gold. But as for your risk management strategies, they should be about the same as any other currency. Okay, so let's take a look at some trade management strategies. Okay. So the anatomy of a trade, basically you guys know this. This is pretty basic. Your entry, stop loss orders, take profit orders, but it also takes into account your break even, partial profit, idea and validation, trading stop loss, as well as diversification of your portfolio. So we go through these more in depth in our other webinar series on risk management, but I'll just go through a couple of exit strategies as well as entry strategies in this webinar, and then we'll take a look at the gold charts after this. Okay, so why is it important to have a trade management strategy? Firstly, is to control risk. Okay, so trade management strategies such as stop loss orders and position sizing helps traders to limit their potential losses and manage their overall risk exposure. Next, we have maximize profits. So trade management strategies such as take profit orders, as well as trading stops that we'll get into a bit, helps traders to lock in profits and maximize their returns. Thirdly, manage emotions. So the discipline and structure that trade management provides can help traders to stay calm and rational even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Fourth, improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more informed decisions and avoid the cost and time of having to constantly monitor and adjust their positions. 5, increase consistency. So effective trade management strategies helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay, so problem with a fixed take profit or stop loss. Okay, so let's take a look at this example. The red area shows a strong resistance area since there have been 2 swing highs in line with this level. Okay, if our trading strategy requires us to have a fixed take profit of 100 pips, we will place the target beyond this strong resistance area. Okay, so let's see how this plays out. You can see price shot up, but it missed it by a few pips before reversing back down. The reason for this is because price tends to reverse off of big areas of resistance and support. Okay, so in an alternative scenario, if we had placed our take profit before the key resistance area, we would have gotten a profitable trade. So it's important to look at the charts and adjust your take profit and stop loss accordingly. Okay, so this is the proper stop loss and take profit placement that we tend to recommend. Okay, so your stop loss, we typically recommend you to place it beyond the major resistance area, and the take profit will be placed before it. Okay. Okay, and this is the reason for it. Okay, because price is attracted to strong areas of Fibonacci. So when we're talking about confluence, here we're talking about Fibonacci confluence, but it could be confluence for anything. So if you're using pivot point levels, if you're looking at dynamic support and resistance by using your Ichimoku or Bollinger Bands, any indicators that you like to use, even your support and resistance levels, okay? When two or more of those indicators line up at a specific level, that forms a confluence area. So price is attracted to such areas of confluence, and if your stop loss is right before it instead of beyond it, you'll most likely get stopped out before the market reverses. So that's why people might wonder why they got stopped out right before the market starts to reverse and then complain about stop hunting. So if we're talking about take profit, we always recommend you to place it before a key confluence area. The reason for that is because when price reaches the confluence area, there's a high chance that it won't be able to go beyond it because of the amount of resistance or amount of support at that area. Okay, so instead of reaching your profit target, it'll reverse back to your entry or worse, your stop loss. So that's also one of the reasons why people complain that the market is being manipulated because they miss their take profit by 1 pip. Okay, here's an example to show you why you shouldn't have a fixed stop loss. So this applies for really any trade that you are looking at. It doesn't just have to be for gold. Even if you're trading currencies, it's the same thing. Okay. So here's an example. So here we have a support level with two swing lows that are in line with one another. Price has bounced off this support level and we are expecting it to continue to rise to the swing high resistance. So our stop loss of 100 pips is fixed at the 1894.75 level. Okay, which is at this support level here. Okay, but instead of heading towards our take profit, price actually goes down and touches your stop loss and bounces up perfectly. Okay, so what we should have done instead was to place our stop loss slightly beyond the key level of support or resistance so that we are not stopped out at the support, since price tends to be attracted to key levels of support and bounces off of them. Okay, so let's talk a bit about some entry and exit. Okay, in this case, we're talking about stop loss placement. So exit strategies. Okay, so this is why it's important to have dynamic stop loss and take profit placement. Dynamic stop loss is a trading strategy that's used to manage risk, in which the stop loss level is adjusted dynamically based on market conditions. The level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses. So the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trends. Okay, so let's look at some indicators that you can use. Okay, so firstly here we are looking at a simple example to demonstrate a dynamic stop loss. Okay, so price firstly bounced off nicely off of the support level here. So it's a swing low support at 86.721. Okay, and we're expecting it to reverse off of our entry at 87.819. Which is also in line with this 100% Fibonacci projection level. Okay, so we see here that if we're thinking of where to place our stop loss is over here at the swing high, which is also in line with minus 27.2% Fibonacci expansion, as well as the 61.8% Fibonacci projection. And you can see price did rise to our entry and is kind of testing this area here. Okay, so the stop loss should be placed beyond the Fibonacci confluence area instead of before it, like you see here. Okay, oops. And you can see we would have been stopped out if the stop loss was placed at this Fibonacci confluence instead of beyond it. Okay, so it managed to reverse off of it, and it's heading back down to our take profit. Okay, so it perfectly reversed off of the confluence area here and towards our take profit. Okay, another example here. So we expect price to bounce off of our entry at 87.625 over here, and the pullback resistance in line with this 78.6% Fibonacci retracement. Okay, and our stop loss is a swing high resistance, take profit is a swing low resistance, support. Okay, so price has hit our entry and has reversed nicely off of it, as you can see here, and is nicely heading towards our take profit. Okay, and then we're using Fibonacci to further complement our take profit levels. Okay, so price just touched our take profit before reversing off of it. Okay, so you can imagine if we had placed our take profit before, beyond it rather, if we had placed it underneath our swing low resistance as well as the Fibonacci level, we would not have been able to catch this before it reversed back up to our stop loss. Yeah. Okay, I think you guys have gotten it by now. Just one more example here. Price recently broke out of this descending trend line. Okay, and we have 3 Fibonacci levels that line up with our take profit here. Okay, and price is currently at our entry. Can see if we place our take profit above the confluence area, price would have reversed off of the confluence area and missed our take profit by a few pips. Okay, so instead of that, we want to place it right below it instead. Okay, so some exit strategies that you can use, which are typically a dynamic stop loss and not just a stationary stop loss or a fixed stop loss. Okay, so trading stop loss. Trading stop loss is a special type of trade order that moves relative to price fluctuations. So we're using a lot of different indicators to support when you should enter or exit your trades. Okay, so when the price goes up, it drags the trailing stop loss along with it. But when the price stops going up, the stop loss price remains to the level that it was dragged to. So it's an order type that's designed to lock in profits or limit losses as a trade moves favorably. Automatic trailing stop loss moves accordingly as price moves favorably. Manual trading stop loss. It's moving stop loss level based on mechanical indicators. Okay, so here are some of the indicators we're using. Okay, firstly, we have you have your moving averages, okay, and then you have your parabolic saw, or is that, I think that's the chandelier, and then we have the ATR, we have your support and resistance levels, and then this is your parabolic saw, okay? So let's talk about how exactly you can use them. So trading stop loss is over here, we have a sell entry. So our sell entry, here we're using a moving average, and we can see price is moving, it's breaking out of this ascending trend line. Okay. Here, if we're using a moving average as a trading stop loss, our entry is here when it breaks out of the trend line, and it also breaks out of the moving average. Okay, so we're using breakouts here moves under instead of over. You can see moving over here, and then it breaks out, moves under, and then the trailing stop loss is triggered over here. Okay, and it got us out before this happened. Okay, another way is by using trend lines. So here we have a descending trend line. Okay, so what makes a descending trend line, just to recap, is to have 3 significant levels that are touching the line. Okay. Yeah, minimum 3. Okay, so our entry is here because price has broken out of this ascending trend line. Okay, and it's currently moving in a downtrend. So we have a descending trend line, we have an ascending trend line, and once this trend line breaks out of it, then we are stopped out. Okay, here we're using parabolic SAR. So you see our sell entry is here. Price moves under the ascending trend line, and also the parabolic SAR. You can see it's moving underneath instead of over in this case, until it breaks out of the ascending, or rather, it breaks out of this parabolic SAR line. Okay, and then a trailing stop loss is triggered. Okay, here chandelier and ATR. Okay, same thing, sell entry with this line. And we're using both ATR as well as chandelier in this case. So both moving under, and the trailing stop loss is triggered once price has broken out of these 2 indicators. Okay, so this is how we use it in an example. So here we are using Kiwi dollar, but of course you can use it for any commodity, any currency that you're thinking of trading. So once again, we have a price breaking out of this ascending trend line. Okay, it's also moving, or rather it's breaking out of the moving average, and it's moving downwards, or rather it's moving below. Okay, so here we see price moving above the moving average. Once it breaks below, that's a sign that we could see a change in trend. So it's moving downwards. Here is our sell entry, and we're going in for a sell towards our take profit, which is over here. Okay, at this swing low here. And then we are stopped out when price hits this moving average and breaks above it. Okay, last example, dollar CAD. This is a support and resistance example. So we see price once again breaking out of this ascending trend line. So that's our sell entry, with our stop loss placed just slightly above, and I'll take profit at the swing low here. Okay. Okay. Now, let's take a look at, let's maybe analyze gold together now. Okay. So I like to start off by looking at the higher time frames first, the weekly and daily time frames. Okay, because then I get an idea of what the general directions are of the trend. So you can see there is an uptrend here, but it looks like there has been a recent reversal. If we look at our daily time frame, we don't have any trend lines or trend channels here. Yeah. Okay, we don't have any trend lines or trend channels, but we can see price definitely moving slightly in a downtrend. Okay. Okay, let's look at our 4-hour time frame. 4 hours is it looks kind of bullish here, even though there is a reversal recently. And let's look at 1 hour. Okay, 1 hour is pretty bearish. Okay, so if you want to compare, let's take a look at DXY. Okay, so if you're not super sure mm, what the directions are, you can always compare with DXY, since we mentioned that DXY as well as gold tends to be negatively correlated. Okay, so we see prices kind of increasing on our DXY. So we can expect the opposite on our gold. Okay, I'm not sure why it's bugging out on me right now. Okay, yeah. So you can see it's moving downwards, whereas DXY is moving upwards. Okay, so let's go in with our support and resistance levels now. Or actually, let's see if we can find any channels. So the first step is always to look for the general trend. So you want to see if you can find any trend lines, which I can see over here. I have a descending trend line with 3 significant touches, as you can see. I can also see that price is moving in this descending trend channel. Okay, so for a valid trend channel, you need 2 touches on top and 2 touches below. And now let's go in with our support and resistance levels. Okay, so I try and pull it back as far as I can, so without cutting too many candlesticks, so that I can see how significant this level is. So here, this is my first resistance. This may be my first support. Okay, and then okay, maybe here. So this is purely graphical, just by looking at support, just by looking at the swing highs and swing lows. Okay, so it's not, you can always go in with your Fibonacci levels and adjust them accordingly. Okay, so now I'm gonna go in with my Fibonacci levels. Here you can see my 23.6% Fibonacci retracement lines up nicely. And okay, my 78.6 also lines up nicely. I think my 100% also kind of lines up with my first support, because these don't necessarily have to line up exactly, because they're more so areas than levels. Okay, and I like to get rid of the 0 and 100 if it's not necessary. Okay, let's see what else we have. Okay, my 23.6 lines up with my first support as well. Okay, so you can see that this first support is pretty significant here. Okay. Okay, I think that's all the levels that we have. Now let's go in with some indicators. Okay, price is moving below the Ichimoku cloud, so it's in line with our bearish signals, whereas MACD is giving us a bullish signal. So I'm going to get rid of that. And let's look at RSI. Okay, RSI isn't really telling us much. Let's take a look at moving average, EMA, and SMA. Okay, so price is moving below our EMA, so it supports our bearish signal. And over here, we see that price has crossed over, which signal a change in trend. And you can see price definitely did drop over here. Price is also continuing to move below our SMA, which also supports our bearish signal. And because they haven't crossed over each other, we can continue to expect that price is going to continue in this downtrend. Okay, but I will say that because there is a confluence area here at our first support, and that's why you see price being attracted to this area. We could see a bit of resistance here and price reacting off of this area as well. So yeah, just keep that in mind. Maybe let's look at Bollinger Bands as well. Okay, on our Bollinger Band, you can see price. Let me make it bigger. Can see price pushing below the lower band of our Bollinger channel, which is also a bearish signal. Okay. So yeah, we could see prices continue to drop here. Okay. Let me know in the chat if you guys have any questions. Okay, if not, that's all I have for you guys today. Thank you guys so much for joining me. I hope you guys found it helpful, and I will see you guys next week. Have a great rest of your week, and see you guys soon. Bye.